Let's get right into it. Today, we're putting on our macro strategist hats for a deep, data-driven explainer on the institutional realities of HSBC, looking closely at their full-year 2025 results. You know, when most people glance at HSBC, they just slap the large global bank label on it and completely move on. But as fundamental analysts, we know that label is way too broad, and frankly, it misses the entire point of the business.
So what exactly is HSBC? Let's benchmark it against some peers. JP Morgan? That's a fortress, US-centered universal bank. Morgan Stanley is primarily a wealth and institutional securities platform. Goldman Sachs is your classic investment banking and markets franchise. But HSBC, it's not a US-style consumer megabank, it's definitely not a pure investment bank, and it is certainly not just a local Hong Kong retail bank.
Okay, let's dive into this. The market consensus honestly gets it exactly wrong. It's not a pure domestic bank, and it's not a pure investment bank. The reality is actually far more interesting. It is a cross-border flow hub. Its entire core purpose is to connect clients, capital, trade, deposits, payments, FX, and wealth across borders. Its true identity is a hybrid bridge sitting squarely between East and West. Here's the analytical roadmap we're going to follow today to really understand this machine. 1. The cross-border money bridge. 2. Its origins and the three-layer model. 3. The four-part global structure. 4. Decoding the 2025 financials. And 5. Weighing the moats against the macro risks. All right, part 1, the cross-border money bridge. This is all about moving, financing, and storing money across borders. The absolute fastest way to grasp HSBC's true value is to understand that their product isn't just a loan, and it isn't just a deposit. The real product here is the capability to move, finance, hedge, store, invest, and report money globally, all while staying seamlessly inside regulated banking channels. Think of this bridge as having 5 distinct lanes: trade, payments and cash management, foreign exchange, offshore wealth, and capital markets. I mean, think about financial friction. It acts like a massive invisible corporate tax, right? If a multinational company needs to collect revenue from Europe, pay its suppliers in dollars, finance inventory over in Asia, and hedge its currency exposure all at the exact same time, well, HSBC exists because those problems are incredibly hard and solving them efficiently is extremely valuable. Moving to part 2, origins and the three-layer model. Let's look at how an 1865 trade bank became a modern flow flywheel.
To really get the modern business, we actually have to look backward at the bank's original DNA, mainly because it translates perfectly to how they operate today. HSBC was founded back in 1865 in Hong Kong and Shanghai with one very specific purpose: financing trade between Asia and the rest of the world. It literally followed the trade routes. It wasn't built on local retail deposits, it was built on international commerce. Fast forward to the 1990s, and they acquire Midland Bank to secure a massive domestic anchor in the UK. And now, looking at 2025, they've intensely refocused on Asia, wealth, and that core cross-border flow. This historical journey is exactly why the bank has this unusual dual identity today: deep Hong Kong roots, but a London headquarters.
And that brings us to the core business logic, what we call the three-layer model. Layer 1 is the balance sheet, taking in deposits and making loans to create funding and spread income. Layer 2 is the flow business, payments, trade, FX, and cash management. Now this is the true heart of the bridge, monetizing recurring cross-border activity and essentially embedding the bank deep inside corporate treasuries. Finally, Layer 3 is the relationship business, wealth, private banking, and capital markets, which deepens the client value over time. You really need to lock in how these 3 layers interact, because they drive everything else. Let's just pause on that thought for a second. Let's quickly recap this foundation. Born as an 1865 trade bank, driven by the 3-layer model, and its core moat is deeply embedded transaction banking. This is the absolute bedrock of the franchise. Take a few seconds to just mentally screenshot that.
All right, part 3, the 4-part global structure, the geographic and strategic matrix.
So, moving from the theory to the execution, here is how the bank actually operates today under its 2025 structural reorganization. They've organized into 4 distinct segments. First, Hong Kong, the crown jewel. This is the emotional and economic center of the bank, generating immense profitability and serving as the primary gateway to mainland China. Second, the UK, the domestic anchor. This gives them a highly stable retail and commercial ballast. Third is CIB, corporate and institutional banking. We call this the flow engine. This is where the cross-border scale happens outside of their home markets. And fourth, IWPB, International Wealth and Premier Banking, the wealth bridge. This captures the personal wealth that's inevitably created by all that global trade. Think about how those pieces fit together for a second. To summarize those strategic roles, Hong Kong is the high-return gateway.
The UK is the stable domestic base. CIB acts as the institutional cross-border bridge, and IWPB drives international wealth compounding. Just let those four pillars sink in. Which brings us to Part 4, Decoding the 2025 Financials. How do we read the ledger of a cross-border flow hub?
If you're looking at this ledger like you would a normal industrial company, you are doing it wrong. A global bank has to be analyzed starting with the balance sheet, not just the revenue line. Now, what's really interesting about this slide is the sheer scale of the raw material at play. At year-end 2025, HSBC had $3.23 trillion in total assets. But the critical number beneath all of that is the $1.79 trillion in customer accounts. And we're not just talking about generic savings accounts here. The most valuable of these are operational deposits tied to actual client activity, things like corporate payrolls, trade liquidity, and massive cash management pools. This is the raw material that fuels that massive balance sheet.
Which translates directly into this, a 17.2% return on tangible equity for 2025, excluding notable items. Now sure, the reported ROT was 13.3%, but when you adjust for true non-recurring noise, like the dilution and impairment losses tied to Bank of Communications or the sale of a French mortgage portfolio, you see the true underlying operating power of this franchise. And 17.2%? That is a tremendously strong baseline return.
And when we look at where that 2025 revenue actually came from, the mix is super revealing. Corporate and institutional banking leads the pack with $27.6 billion, providing massive cross-border scale. But look right next to it at Hong Kong, $15.9 billion in revenue. Hong Kong produces extremely high, concentrated returns, literally a 35.5% ROTE locally. IWBP brought in $14.5 billion, and the UK provided a solid $12.9 billion. So here is your 2025 ledger summary. $71 billion in underlying revenue, a rock-solid 14.9% CET1 capital ratio, and $6 billion in share buybacks, though management did pause further buybacks pending capital recovery from the Hang Seng privatization. But remember, capital return is always an output of capital strength, not the core engine itself. What these numbers really represent is a fortress balance sheet. Take a moment to process that ledger.
Finally, Part 5, Moats versus Macro Risks. Let's break down the intrinsic value formula and the valuation discount.
We've seen the undeniable cross-border moat, but now we have to look objectively at how Wall Street weighs that moat against current geopolitical realities. A serious valuation framework for HSBC requires 4 distinct layers. First, tangible book value. That's your baseline. Second, sustainable ROTE. This is the premium driver. The core question here is whether HSBC can sustainably earn above its cost of equity through the entire economic cycle. Third is capital return, which provides your yield. And fourth is the discount factor. And this last one is absolutely critical because it captures the geopolitical risk and the credit risk unique to an institution sitting perfectly between two global systems. Let's start with the bull case. Look, global trade isn't disappearing, it's fracturing, which makes it vastly more complex. And as trade breaks down into regional corridors, a bank that has mastered multiple jurisdictions becomes more essential, not less. Add to that the $2.1 trillion in wealth balances that are quietly compounding, those incredibly sticky operational deposits from transaction banking, and a completely unmatched footprint across major Asian and Middle Eastern growth markets.
But we absolutely must neutrally weigh the discounts. HSBC's value comes from connecting systems, but its risk comes from those exact systems distrusting each other. The geopolitical friction between East and West is a constant, heavy regulatory burden. On the credit side, exposures to Hong Kong and mainland China commercial real estate remain absolute watchpoints for analysts. Combine that with the risk of lower rates compressing net interest income and just the sheer operational complexity of running a global matrix of this size, and you have highly rational grounds for a valuation discount.
So the valuation verdict is basically this. HSBC's premium relies entirely on its ability to sustain fee and flow income. Its discount is driven by whether it maintains the geopolitical permission to operate. The intrinsic value equals tangible book value plus flow row NTRATE minus complexity risk. Just absorb that equation for a moment. Ultimately, the entire HSBC investment debate comes down to one core question. Can HSBC keep earning attractive returns from cross-border flows while managing the risks of being the bank between China, the UK, and the dollar system? The true reward of operating the global bridge is immense, no doubt about it, but the toll of maintaining it is just as steep. Thank you for joining me for this explainer. We'll see you next time.